Welcome, folks, to yet another video on the Noob Investor. Have we seen this campaign, Mutual Fund Sahi Hai? I think this is a campaign run by the mutual fund companies as well as supported by SEBI for maybe past 10 years. Mutual Fund Sahi Hai. There is always a caveat whenever you see this campaign running, right? That mutual fund investments are subject to market risks. Read all scheme documents carefully before investing, right? So, what is it that we are supposed to read before investing? There are over 1,500 mutual funds schemes from across a lot of fund houses. How do we choose a mutual fund? Which mutual fund is good for us? So in this video, we'll look at what kind of factors do you need to consider before investing into a mutual fund. If you read online, you read others people, you'll see that they'll talk about a lot of things before investing into mutual funds: trailing returns, expense ratio, rolling return, Sharpe ratio, load structure, alpha, beta, capture ratio, turnover ratio. My God, by the time I look at each of this, I think I might be ready to die, right? It's too long, too tedious of a process. And I don't even know whether I can look at so many aspects and come up with a solution as well. So what I'm going to try here today is get a much simpler and structured approach of how to analyze and choose a mutual fund, right? So first aspect is, how do you allocate? So before talking about allocation, according to AMFI data, about 55% of equity mutual funds have been held for a period greater than 24 months. This number was less than 50% about 2 years back. Right? So we are seeing that people are actually moving towards more long-term investing. But even AMFI and SEBI don't publish data of how many people actually hold mutual funds for more than 3 years. So for me, if you talk about a mutual fund, minimum investment time should be 3 years. Anything less than that, you can look at any other asset classes, be it FD, gold, or you want to trade in stocks, trade in stocks. But if you're investing in a mutual fund, it should be minimum 3 years. And I'm sure if SEBI ever published the data, how many people hold equity assets for more than 3 years, it will be maybe 20%. And if it is more than 5 years, it will be hardly anybody. So that is the first thing we need to understand is when you are allocating your assets to mutual funds, it has to be for a minimum period of 3 years. Then we can talk about how do we allocate these in equity. I am completely in this video talking just about equity mutual funds. I'm not getting to debt and hybrid. So there are majorly large cap, mid cap, and small cap. So how much of your money do you want to park in large cap, mid cap, small? Large caps are safer, small caps are more risky. But there is a concept, or not a concept, there is a feeling that small caps provide more returns than large cap. Yes, because they're smaller, so they have a scope to grow much larger, right? Whereas it is much more difficult for a larger company to grow. If you are not sure about how you should allocate your funds into large, mid, and small, it all depends on your risk profile. But you can also choose flexi cap and multi cap funds, which do this allocation for you rather than you having to decide that this is what I want to put in large cap, mid, and small, right? So this is the first part. Ensure that you are investing for a long time and allocate on large, mid, and small caps. Second part. Now, whenever we choose a mutual funds, typically what do we see is historic returns, right? If you see, I am choosing like four very popular small cap funds here. These have given very good returns. These have over the past 3 to 5 years, and they have a large AUM size also. So a lot of people are investing into these funds. So if you see trailing return, what is trailing returns? That as on today, 3 years back, if you had invested, this is the CAGR you would have got, or 5 years before. So this is what is called as point to point return. So let's say this today, if it is 1st January, from 1st January of 2019 to 1st January of 2022, that is your 3 years trailing return. Same way up to 3 years, if it is 5 years, it is 5-year trailing return. Is this value of any use? Have you invested exactly 3 years before or exactly 5 years before? No. what happens is that we invest on a continuous basis. Mostly SIP is a format where mutual funds are invested into. Even if it is not mutual funds, as and when, not SIP, you invest in mutual fund as and when you have money, right? So you point to point returns or trailing returns are actually a very bad metric to look into before investing into a mutual fund. So like you see here, last 5 year returns, if you see, and even 3 year returns, quant small cap fund has outperformed every other fund in the small cap category, right? But let's go into rolling returns. So rolling returns I typically see for 3 years. Why do I see 3 years? Again, like I said, minimum investment should be 3 years. All right. So what are rolling returns? So rolling returns calculates returns uh, of 3 years for each and every possible day. So if it is today, today's return for 3 years is this much, yesterday's return for 3 years was this much, previous day was this much. So it calculates the rolling returns for each and every day since inception, right? So this is basically 10-year data. This is not since inception, but this is last 10-year data. That is good enough, right? So if you see here, right, the what is average? If you see the average return is still fine. But what is more important to look at here is median return, because median basically gives you the most probable return that you will get in a 3 year investment cycle. So this is where you'll see that maybe quant mutual fund has performed much lower than the other mutual funds in this category, right? But it has given max return of 71% as well. So this basically is telling you that this fund has high volatility or high variability in returns. If that is your risk profile, if that is what you want, go ahead with it. You'll see something like the other funds, they are more stable returns across the board, right? Even the minimum return. So there are times when markets are low for 3 years, even that is lower for, let's say, Nippon and HDFC mutual fund. So this is a gives you a fairer idea, and you have to invest in whatever fits your risk profile here. Correct. So do you want higher return but a higher downside risk, or do you want stable returns? Now, another thing you will see, notice here that category average is much lesser than the benchmark, which is Nifty Small Cap 250 here. So in general, this category of mutual funds has not lived up to or provided same returns as the Nifty Small Cap. This is something to consider also before investing, right? So next, now another very important ratio that I look at is portfolio turnover ratio. Basically, portfolio turnover ratio tells you that how many times or what percentage of their portfolio was turned over in the previous year. So basically, if it's a high percentage, that means you are turning over your stock, you are selling and buying stocks at a more frequent rate. And if you have a low portfolio turnover ratio, means you are investing for a longer term. You're holding your stocks. You are not really churning out your stocks a lot more. So this is where you'll find it very interesting. You see, quant mutual fund has a 128% turnover ratio. What this means is they are churning out their stocks. They are investing for a shorter term, which is why you will see very high variability in their returns, which we saw in the previously, right? So that is why you have a max return of 71% and a median return of 10% only. Whereas Nippon, HDFC, they have and even Franklin, they have much lower turnover ratio. So they are more steady returns. So this is also the difference between a short-term investor and a long-term investor. Short-term investor turns around their portfolio much more, whereas a long-term investor holds their stock steady and invests for the long term. So again, whatever fits your investment style, that is the kind of mutual fund you should go for. Other ratio which is important is, of course, expense ratio. Now, I typically find that anywhere between up to 0.7, 0.8 expense ratios are fine. If you can get a expense ratio lower than that, well and good. But make sure you're not investing in a regular fund, because what happens in a regular fund is that up and above this direct expense ratio, the distributor or broker in between gets about another 0.7, 0.8, even 1% sometimes. So your expense ratio becomes 1.5, 1.6, which basically kills your returns. So be careful and be aware of direct and regular plans and look at the expense ratio as well. Now, last thing that I look for is in these mutual funds. So let's say I'll take up the first two mutual funds here, which is Quant and Nippon, and see what are the top 10 holdings of each of these funds. So if you see here, this is for the quant. You see that the top two holdings are actually huge mega caps. Reliance and Geo Financials, which are actually in terms of market cap that within the top 50, right? These are large caps. Why is a small cap mutual fund investing so heavily in large caps? Why is the top two holdings in large caps? So this actually scratches my head, right? But then you have to understand that SEBI recently came up with something called as a stress test, where they said that every mutual fund has to analyze that how can they liquidate their portfolios in case there is a stress selling in the market, right? This has happened a lot before, where there's a lot of selling in the market and mutual funds have to liquidate, especially the small caps. And when you liquidate small cap, the small caps stocks fall even further. So this is why small cap funds are now taking large cap companies as well in their portfolio. Why? Is, let's say they want to liquidate, right? So it is much easier to liquidate a large cap stock than a small cap stock. And a large cap stock, it won't fall as much as a small cap when there's liquidation happening. So this is the reason why certain mutual funds are going towards large cap. So you need to be wary of this and check your allocation based on this, because let's say typically the large caps that most of these funds like are Reliance, HDFC, ICICI, because these are the three big companies where you have a lot of liquidity in the market. So your stress test results are always good, right? So it is really a way to work around the stress test more than actual investment into these companies. So maybe you should look at this as well while investing. Then when we look at Nippon, right? Uh, Nippon, here you will find that yes, there are a few large caps here as well. You have 6% allocation to large cap, but the individual stock weightage is much lesser. So maybe this is a more stable fund. Like we also saw that their portfolio turnover ratio is much lesser. So they don't have a huge issue of turning over the stocks, and they keep these stocks and hold them for longer. So maybe for me, this looks like a good mutual fund to invest into for small cap. Again, this is not a recommendation. Please do your own research before investing. You need to understand what your style of investing is. So, as a summary, I'll just put it up that think long term. Always for mutual funds, minimum 3 years. I would say 5 to 8 years is a good time frame to look at mutual funds. Look at rolling returns instead of trailing. It gives you a much better idea because you are never going to invest point to point. You are going to invest in SIPs or in lump sum over time on different dates. Trailing returns make no sense for you. And last, portfolio turnover and top stock allocation. This is more to understand what kind of investment is the fund doing. Does that suit your risk profile or not? Thanks for watching, everyone. Please make sure to like, share, and subscribe to the video. Stay investing. Bye bye.